At the very end of the week, we had a fair amount of Secretary of Treasury action there. One of your successors took some action. Secretary Mnuchin wrote a letter to the head of the Fed, Jay Powell, saying, please give us back that money we gave you for those emergency lending facilities. And you had something to say about that. In fact, you had a tweet in which you said Secretary Paulson, referring to Hank Paulson, another predecessor, understood in a transition it was his job to help the Fed and the incoming administration establish a basis for strong cooperative efforts to contain the crisis. Secretary Mnuchin has done just the opposite. So drawing a contrast between these two secretaries, what is going on here, Larry?
I think they're two separate points. One, every previous government, I mean, there was plenty of bitterness in the Bush-Gore campaign. Really, there was. I mean, we all thought that election was stolen. But it didn't occur to me or to anyone who worked with me or to any other cabinet officer in the Clinton administration not to cooperate fully in helping the government be ready to do whatever our successors wanted to do. The last thing we envisioned doing was thwarting their ability to carry out their policies. What Steve Mnuchin did in writing that letter and making those demands and reducing the authorization was thwart what it's clear an incoming Biden administration wants to do. So that's just wrong on process terms. The second problem is it's just incredibly imprudent and reckless at a time when the pandemic is getting far worse, at a time when we don't really know where this pandemic is going to go before a vaccine, at a time when we don't have any basis for being confident that there's going to be agreement on fiscal stimulus, to tie the Fed's hands in any way to constrict their abilities to act in an emergency is the height of foolishness. Why would you throw away a potential insurance policy? Nobody's asking Secretary Mnuchin to trigger anything, to pay any money, to authorize any checks that he doesn't want to. But preserving the capacity to insure against financial Armageddon, it's elementary that that's the right thing to do. It's elementary that it's the right thing to do to facilitate a next administration being able to do what it thinks is wise. I've been surprised by the secretary before, but never more than this, which really does seem to me very much outside the tradition of the office he holds.
So this is a transition that at some point presumably will be over. And then at the same time, there are longer term issues at play here. And just this week, Bloomberg had the New Economy Forum that you appeared on with Janet Yellen, the former Federal Reserve Chair. And one of the subjects was actually, are we saving too much? And are we really in secular stagnation? A term that you really revived some years ago. And she basically totally agreed with you. This is part of what she had to say.
Central banks need to do what they can, but then not overstate what it's possible for them to do. Well, I strongly believe central banks need to be independent and need to do everything they can. The changes they've made, they're not a game changer from the point of view of secular stagnation. And bottom line, I agree with Larry on what's required.
So there you go, Larry. Things have changed some from the first time I think that you issued that paper some years ago when you were sort of an outlier, I think, on the subject. But that leads to the question, okay, if central banks can't fix this and we're in secular stagnation, what do we do about it? What does it mean for longer-term economic policy?
It means we're going to have to rely on fiscal policy rather than monetary policy to stabilize the economy going forward when we have cyclical fluctuations. And it means more generally that an important part of the design of policy is going to have to be assuring that savings are fully absorbed. Because when you have excess savings and there isn't investment that absorbs that saving, that's when you get interest rates on the floor. That's when you get the savings flowing into purchasing existing assets, leading to financial bubbles and leading to huge degrees of leverage. That's when you get lack of inflationary impulse and an inadequate inflation relative to the targets. And that's when you get the sluggish growth that leads millions of workers to be left behind. This isn't a phenomenon of the United States. It's a phenomenon throughout the industrial world. Nowhere are interest rates at anything like the levels that would have been regarded as normal. And nowhere is there any market judgment, if you look at longer term interest rates, that they're going back to normal. And so we've got to move to a very different paradigm that under today is not that an undisciplined central bank is going to create massive inflation. It is not deficits are going to crowd out private investment. Right. We're going to have all this savings and we can't absorb it. And that is what central banks need to be saying. That's what political leaders need to be understanding.
Right.
Keynes talked about this time ago, both in substance and have to understand the basic economic forces to do the right thing.
Which leads us naturally to a quick lightning round of Summer Says, because one of the questions is the stimulus. Are we going to get stimulus, and how big does it need to be?
It should be more than $1 trillion, and it's odds off that we'll get it before the inauguration. Unfortunately, because of transigence on both sides.
So odds off that we're going to get it. Should be more than $1 trillion. Let me take the flip side of this argument for a second, which might surprise you. We've had some people like Martin Wolf in the Financial Times this week writing about the possible recurrence of inflation, actually. If we get the vaccine and things bounce back, is there any chance that, in fact, we could have the reverse of your problem and actually have inflation by the end of 2021?
Of course, by the end of 2021, I think it's pretty unlikely, but anything's possible. But, you know, mathematicians have a phrase, this reduces to the previous case. If we found ourselves with an overheating economy and we had to raise interest rates and the Fed was important again and it was no longer pushing on a string, that would be really good. That would be a much better situation than the kind of profound long-term sluggishness that has led to such disillusionment around the world.